Well, hello attendees in listen-only mode. Larry Berman here. Quite another week. Everything from Putin today suggesting that nuclear option was on the table. I know there had been some chatter a few weeks ago about that, but it seems with Finland really serious about joining NATO that that escalates things with the U.S. giving more advanced offensive weaponry to Ukraine, and by all means they should be doing that. Anyways, the markets can't seem to hold a bid here. There was a couple of times last week where we had 1 or 2 day rallies, and then it failed right back to the lows. And we saw a rally on Wednesday, and today that rally failed back to the lows. Some key sectors are breaking support levels. The market and the tape is just not healthy at the moment. So I'll get into a little bit more of that. And as everybody knows, the repository for all our educational material. Esther Choi from BMO is going to join us in a minute, and she's going to tell you what she's going to tell you is educational. And that really is the emphasis here, is educational. It's not investment advice. However, you can take it as investment advice when it comes from me, with the caveat that I don't know who you are, right? And I don't know your risk tolerances or anything like that. What our goal here is in these series of webinars, and why it's called the Investor's Guide to Thriving, is to teach you how to do it a little bit better. And every time we go through one of these, we get great feedback from people, and so I hope everybody's enjoying them so far. We've got 2 more left after tonight in this series. The final one is going to be on private credit and private equity, and how you can get exposure to those asset classes by way of ETFs and other sources. And I think, the more and more I look at what Canada Pension Plan has done with their portfolios, and other people, running serious money in terms of having to deliver a return and meet an obligation and a liability, what they're doing with their portfolios is so not generic 60-40 thinking. It's so not about picking stocks. It's really about creating a solution for an investment need, and that need being funding retirement. And I think for most of us here, funding your retirement, clipping the coupon, lowering the volatility, really that's all, what it's all about. And our partners that support us here in putting on these efforts, really emphasize the education and the transparency about, what goes on in the investment world. And our biggest and favorite partner has been BMO Exchange Traded Funds since literally since day one. And BMO is now, the leader in Canada in the ETF space, and we're really proud to have them as partners. But I'm going to make the ask again. I know it's tough for everybody. If you're really enjoying these and you're getting something out of this, reach down and really try to support cancer research at sick kids, and or dementia and Alzheimer's research at the Baycrest Hospital and Foundation here in Toronto. These are 2 charities that are very close to myself and my business partners, and any of you who have been on the donation page for Baycrest probably know a little bit about my story and why I'm so passionate about brain health and science at Baycrest. But really, when you can't make decisions about investing, that's one kind of stress. When you don't know who people are that are around you, it's a whole other thing. So, and of course, myself and my partners and all the companies, we match your donations. So it's really a great thing to do, to say thank you for these webinars. And tonight we have our expert on from BMO ETFs. Esther's based out west. and she's going to talk about ETFs. And take it away, Esther.
Hi there. Thank you so much for that, Larry, and for having me here today. As you mentioned, BMO, we have a great and long-standing relationship with you and with ETF Capital Management, so I'm quite excited to be part of this session. And we've been getting a lot of questions with respect to liquidity ETFs, and so thus this part of the portion of the presentation, I will actually address that concern. Before I begin, though, I just wanted to mention that for compliance purposes, as you mentioned earlier, Larry, is that this information that I'm sharing is not for advice. What we're doing is we're not providing any recommendations whatsoever. It's clearly for informational purposes only. We just wanted to provide insights and education to ETFs and the overall market. So going ahead here, ETF 1-minute update. The top 20 largest ETFs in Canada account for 51% of all Canadian ETF trading volumes. While there's been a number of mature ETFs that have emerged with approximately 27 ETFs in Canada with over $2 billion in assets, there's still a great deal of smaller ETFs, and these smaller ETFs actually trade with less than 20,000 shares each day. So to address these concerns, it's actually really important to note that traded volume of an ETF does not measure its liquidity whatsoever. So again, volume is not necessarily a measure of liquidity. We go to the second slide here. We have to be aware of data. When it comes to obtaining ETF data, it's so important that we source accurate and complete information from credible sources, such as Quote Media. Stock Market is another example as well. We're going to use this example of ZEG, which is the BMO Aggregate Bond Index ETF. It's the largest fixed income ETF in Canada. I'm going to use this as an example and snapshots from various sources. We've got good data and we have incomplete data. Stockwatch is showing traded volume of over 344,000 shares. Yahoo Finance is showing a volume of 43,000. And Google Finance, you're seeing just over 166,000 shares. So what's the difference here? Really, it's that Stockwatch is providing more complete and better data with respect to volume. They're actually consolidating all the data across all the exchanges in Canada. So you've got the TSX, the NEO, the Alpha, Omega, some exchanges I personally have never heard before, but what they're doing here is providing more accurate and good and complete data. Good takeaway from this slide is that, again, volume does not necessarily equate or is not the only metric that you need to look at as it relates to liquidity for ETFs. We really do need to do your research and your due diligence. Now, when we go to this understanding liquidity, it's really about the ability to buy and sell security efficiently and quickly. So liquid assets experience little to no change in asset value when it's converted or traded. And also it removes some investing risks by ensuring that investors will be able to quickly react to market moves. As well, stocks and bonds is equal to its trading volume because the stock has a fixed supply, a finite supply of shares. Versus ETFs. The liquidity of ETFs actually is much deeper because ETFs are open-ended funds, which essentially means that more units of that ETF could be created or destroyed depending on demand and supply. And with the next slide, I'm actually going to delve into the liquidity of ETFs. This is actually a very important slide, and I'm going to spend some time on this. There are 3 levels of liquidity. The first layer is the natural level. Many of you who have trading accounts are probably familiar with this because essentially when you place an order, the exchange will take that order and match buyers and sellers at a predetermined price, and a transaction is made. Now, the ETFs provide another layer of liquidity, which include market makers. For this, I'm going to use the example of a car dealership. When we need a car, what do? We go to a car dealership, and they have an inventory of cars. And what they'll do is they'll match the buyers and sellers for these cars. Likewise, with ETFs, market makers essentially act as a car dealership. They hold an inventory of ETFs and will match buyers and sellers as it relates to demand and the supply in the marketplace. The question then is, when does a market maker get involved? Essentially always. They're always in the background, making sure that there is liquidity in the for ETFs, and so that transactions go smoothly. The third and final level or layer of liquidity is provided by the ETF provider, such as BMO ETFs. I'm going to use the previous example of a car dealership. Now we're going to include the manufacturer or auto car maker. As demand of cars increases, the dealer will now go to the manufacturer, place an order for cars. The manufacturer and then in turn will source all the different parts, build the car, and then deliver that car to you. As supply increases and demand drops, the dealer will now take those excess cars back to the manufacturer or auto plant maker, and they in turn will disassemble this car or take apart this car and sell the individual parts. Although that latter part is not a realistic situation, this is essentially how ETFs work. So ETFs, as a demand increases, the market maker will now turn to the ETF provider, such as BMO, and an ETF provider will then in turn create more units of these ETFs by sourcing individual securities. And likewise, as supply increases and demand drops, the market maker will then return those ETFs to the market provider. They will disassemble those ETFs and sell off the individual securities. So essentially, those three levels of liquidity is what is baked into the ETF. Because of these three layers of liquidity, ETFs could actually be a lot more liquid than the underlying security itself. As well, when you're trading ETFs for less liquid assets, classes such as fixed income or preferred shares, it's actually easier to trade them than the underlying security. And we're going to actually see this example in the next slide. But essentially, again, as I mentioned, since there is a liquidity mechanism put in place, ETFs are able to provide those the levels of liquidity. When we go to the next slide, ETFs bring liquidity to hard-to-trade assets. The market maker here plays such an integral and important role. Their sole job is really to maintain the liquidity for ETFs, especially with respect to hard-to-trade assets, over-the-counter securities such as fixed income, preferred shares, and some cryptocurrencies. In many cases, liquidity of these ETFs become a lot more superior too. Let's take, for example, March of 2020, when the pandemic hit. Markets dropped 25%. The bond market literally froze. Everyone wanted to sell off their bonds, dispose of it, but no one wanted to buy on the other end. But guess what? When there was no liquidity in the bond market, fixed income ETFs were still trading. And so thus we were able to provide liquidity to ETFs in that space. So ETF liquidity is similar to the bond liquidity, but keep in mind that we have two extra levels, two extra layers, the market maker and also the ETF provider to provide the liquidity. In this slide here, we're going to also see an example of ZPR, which is a BMO Preferred Shares ETF. You can see it's a snapshot in time that was taken earlier this year. So this is actually a live feed from earlier this year. You'll see here that the bid is 11.51 and the ask is 11.52. Now that's a 1 cent spread. That's for the ETF. The underlying preferred share had a spread of 8 cents. So a bid of 11.54 and an ask of 11.62. Not only does ETFs provide a liquidity, but it actually provides a narrow bid-ask spread. We go to the next slide. The impact of large trades. There are so many things to consider. There is a myth that if the ETF is too large, or if the size of the trade is too big, that it will actually impact the markets. And in fact, we've seen so many cases whereby that has not been the case. You have to take into consideration the currency, what's being traded, the time of day, central banks, are they increasing or lowering interest rates, size of the trade. There's so many macroeconomic factors that you need to take into consideration when trades are being done. So let's take an example of ZEG. So this was a real life example that took place last year. We have so many examples, and this is just one of them. ZEG is the largest fixed income ETF in Canada. It's our aggregate bond ETF. The trade was placed 11.20 there. And as you can see that the example here shows that just over 5 million units of ZEG actually provided little to no impact in the market, whether it be the price or the bid ask. That's a beautiful example of how ETFs are liquid and also have very little to no impact in the marketplace. And now if we go to the last slide here, some trading notes that I'd really like to highlight. Uh, when it comes to trading ETFs, really try not to trade at the market open and close for the first 30 minutes and the last 30 minutes of the day, because it tends to be very volatile. We have to keep in mind that so many things may have taken place off hours, big announcements, Bank of Canada or Federal Reserve announcing, movements in the interest rates. We've seen Bank of Canada this week actually increased by 50 basis points that caused some volatility in the markets. We're experiencing a war. There's so many geopolitical risks right now that we're facing. Earning seasons could be upon us. Banks and large corporations might be reporting their earnings. So as a result, it's really encouraged to always use limit orders. You might have a watch list of securities, ETFs, or stocks, or what have you, and you're just thinking, it might be too rich as an entry point, but if you place a limit order, you might actually, with the volatility in the markets, you might actually get in a good entry point. Likewise, conversely, if you have a security that you'd like to sell, an ETF that you're looking to sell, placing a limit order might get you a better sell price. And lastly, when you're trading, keep in mind that it's best to trade when the underlying market is open, simply because when that market is closed, the bid ask might be wider. And therefore, the liquidity also could be not as robust as when the market is open. So that concludes my presentation with respect to liquidity of ETFs. And again, as I mentioned earlier, ETFs provide great liquidity in the marketplace. Looking at volume is not necessarily the best indicator or not the only indicator or metric when it comes to liquidity. Finally, as we close and pass this presentation back to Larry, just wanted to remind you that we are hosting weekly market insight webinars every Friday at 1 p.m. It's a great educational tool for you to tune in to learn about all things ETFs. We have guest presenters and speakers speaking on various topics that are very relevant to the current marketplace. So with that, I'll hand this back to Larry. Thank you so much.
Well, thank you so much, Esther. And I'm going to be a guest on the Market Insights webinar later in May as well. So looking forward to doing that. So, the world's a crazy place these days. And, geopolitics has always been, I've always been a macro guy. I've had jobs on trading desks in fixed income and equities and in commodities. I've always had a much bigger lens on the world. And so, I've never been known as a stock guy. And, started this company 15 plus years ago called ETF Capital Management because I was the core belief that ETFs are the future. And I still believe that for the very basics of investing, ETFs do the job. But as we get into this very, very difficult world, and as we get into a world where there's gross mispricings in lots of asset classes, we're going to enter a period here where security selection may shine a little bit. Doesn't mean ETFs aren't bad at all. It just means that given where we've come from over the last few decades and what's going on now in the world and everything else, that and geopolitics are part of that. But it's really this inflation thing we've had to deal with that probably isn't going away. I don't know how many of you listen to the speeches that central bankers make. Christine Lagarde, head of the ECB, former head of the IMF, former governor of the Bank of France, spoke today on behalf of the ECB and their policy. And you've got this runaway inflation, and you've got them still buying bonds, and so yeah, it kind of asked the question: how broken is Europe fundamentally? If the war didn't happen, would they have ended their bond purchasing program? Or do they really think that underlying all of this, the economy doesn't work unless they're printing money, right? And so it's probably a little bit of everything, but we now have to deal with this inflation that we haven't had to in any meaningful way for decades. Now, I'm not suggesting for a minute that we go back into the 1970s. I don't think that's what this is about. It is supply driven. Last week, I kind of highlighted and talked about an article, a research piece that was put out by a strategist at Credit Suisse, Zoltan Pozsar. And we kind of, one of the phrases that he said is, you can print money, but you can't print wheat and oil, and you can't print a new job. So, you have these issues that the central banks just aren't going to be able to solve. And the critics of the central bank, Danielle DiMartino Booth, I had her on my show on BNN back when we used to do it live in the studio. She had a book out called Fed Up, and she was a Fed researcher, economics researcher for the Dallas Fed, and tells the story about what goes on in those meetings, and it's, I've talked to some people. I was at a cocktail party with one of the Fed presidents, Loretta Meester of the Cleveland Fed. Cleveland Fed is known for their inflation indexes, and we had a really an in-depth talk about those things. And so, you're at a point in time where nobody investing today, including me, really had any practical experience investing in a period of inflation. And all the work I'm doing and the studying that I'm doing, the more and more I conclude with asset classes, and I've said for a long time, the 60-40 model is broken given what's happened to interest rates. Inflation breaks everything. Asset markets that have been pushed, both stocks and bonds, by this deflationary force that the world has had, it's over. It may not be over forever, but it's certainly over for a couple of years until a lot of the geopolitical stuff is fixed. And it could be months to years before there's progress, but I believe there's a new Cold War. It's now a bit of a hot war. I believe that China and Russia will align to want to control commodity / development in the East. And so more of a East-West divide, a little bit less globalization. There's all kinds of debates you can make about global shipping and rates and volumes, and say that, global trade is still robust. And it is. I think we're very, very early in this game, but onshoring and bringing the jobs back, that's going to add to the inflationary pressures. Now, on a geopolitical front, what came across my radar this week, that weekly thing I talk about, my radar is the May 9th date. And I kind of, what's May 9th all about? And so I looked into it a little bit, and the Washington Post had a story, and I put a link up, but really did some Google search. And, there's a pride in Russia about, claiming victory in World War II. So this May 9th date becomes important, and Putin's mentioned it, that the war, it's not the war, the unfortunate circumstances and the military operation in the Ukraine by the nasty war criminal that Putin is, will be over by May 9th. So I don't know what that all means. There was talk today where Sweden and Finland seemed more overt in their desire to become part of NATO. And the response from Putin was, you do that and nukes are on the table. That was the translation and so, we had a big rally yesterday. The market was a little bit bid this morning and then those headlines started hitting the tape, along with a couple sloppy earnings. And, by the end of the day, we made a big reversal pattern. So the geopolitics is mattering. My new good friend and research resource, who was a strategist with Ray Dalio, Andy Constant, and would recommend people follow him on Twitter. He's been really bullish, and he believes that liquidity is a major factor in markets. And today, for the first time, basically said, I'm out of all my long positions. The tape is a mess. And for a fundamentally driven guy to to kind of say that, means something. But I want to take you through a little bit of the move into why factor-based investing is a great lens and a great tool. Couple of good articles here. Again, the links will be there in the PDF that's sent out tomorrow, for your reference. But one of the things that Andy's an expert at is flow of funds, and it's understanding the pressures that will impact the bond market. Andy ran the credit derivatives for Solomon Brothers and was a key player in the junk bond market when it was getting going in the 1980s. So, he's got a pedigree second to none in the investment industry, and he focuses on, where's the money going to come from. So there's a lot of stress on the bond market right now. That stress on the bond market is putting valuation stress on the equity market, to complicate things. But the Treasury, on how they fund the debt and deficits, actually matters to what happens in the bond market. So after the last big stimulus bill that was passed on a bipartisan basis after the election in early 2021, caused a massive amount of excess liquidity. Now, there's been excess liquidity in the banking system for a while. That money finds a home often in the repo market, where they can basically park the money with the Fed and get paid at an interest rate. Interest IOER, interest on overnight excess reserves. That's what it's called. It's done with a reverse repo. So here's a chart of the Fed balance sheet on reverse repos. It's never been bigger ever in the history of the world. There's $1.7 trillion sitting in there right now. And the Fed is going to unwind. They told us last week they're going to unwind approximately 90 billion of the balance sheet a month. So over the next year, roughly $1.1 trillion. How is that going to get funded? So if they fund it all with these excess reserves, because right now this money sits on the Fed's balance sheet, but if they issue new Treasury bills, the safe money with interest rates rising will go into the Treasury bills, and the pressure on longer interest rates will be abated. Right now, the market is worried about inflation with long rates riding, but it's also worried about the balance sheet runoff and the quantitative tightening. So you have this dual pressure. So that's what Andy kind of does the math on. Every quarter, the Treasury announces the refunding schedule in consultation with the TBAC, and that's the Treasury Advisory Committee. Okay, I can't remember what the Treasury Bond, Treasury Bill Advisory Committee. It's made up of the member banks of Wall Street. I think there's 37 member banks that are part of are members of the Treasury. These are the guys that issue the bonds and hold the assets. And when the Fed does repos, that's where they get the bonds from. Where they're buying bonds, that's where they get the bonds from. So therefore, when they're selling bonds, it goes back to the same banks. The next release is scheduled for May 2nd. If Yellen wants, she can fund for the next year the whole QT unwind and get rid of this repo issue, reverse repo issue. And if that happens, we should get a pretty good rally in the long end of the Treasury market. But what that's going to do is flatten the yield curve, adding stress to the notion of a recession. And so it alleviates some stress in the bond market, but it's not necessarily going to stop the recession from coming. You've heard all kinds of talk like that. So if we're heading into a recession and definitely a slower economic period, it's important for investors to understand the interaction between inflation and growth, because at the end of the day, that's ultimately what is the economy and what drives earnings. So there's certain asset classes that when growth is increasing or decreasing and inflation is increasing or decreasing, that tend to perform better. In the Ray Dalio / risk parity model, you would allocate 25% of your portfolio to the 4 scenarios, and the 4 scenarios being, when inflation is increasing and growth is decreasing, when inflation is increasing and growth is increasing, and you kind of see it there, and which commodities, which assets tend to perform best in those environments, and create your portfolio so that no matter what happens, you can extract excess returns from those asset classes. Problem is the excess returns right now have been so compressed because of falling interest rates that you now have a very difficult environment for all asset classes. But where we're heading, cash is king, except cash doesn't pay you anything, but it's safe. So again, depending on who you are as an investor and what you need to live off of, if you go to cash, you've got to draw down your equity to live off of versus getting a yield from the market that you can live off of. And no time soon is that yield going to be, that safe yield or distribution from the asset markets, going to be 5, 6, 7%, so that you can leave your principal and live off the distribution. And that's a model that a lot of people are comfortable with and like. So at no time soon. So again, how and what should you be invested in based on where we are in the business cycle and where we're heading into the business cycle, and what tends to perform best. And this is where factor-based investing really, really helps. And it shines a light, if you will. So there's a lot of charts like this on the internet. I did a Google search. I found something that represented what I wanted to show and talk about tonight. That when we're in the early part of contraction and the late part of expansion, that stocks and bonds and commodities on average do really lousy in terms of excess returns. Excess return is the return above safe money. Call it a treasury bill or a treasury bond, where you know you're going to get your money back after a certain period of time. And what that benchmark is, what term of that, whether it's a GIC or a T-bill or a 5-year bond or whatever, like that's an individual choice on how you do that. But it's the safe interest rate. And the safe interest rate today is still very low. And even if the Fed starts raising rates, that safe interest rate may only get to 2.5% or 3%. which in my book is still going to be lower than what the average rate of inflation is. So your real return after inflation is still crap. And that's the problem with the traditional 60-40 portfolio. Folks, if you're out there and you're thinking in the 60-40, 70-30, 80-20 world, you know, I want to spend a lot of time, certainly in the next couple weeks, talking about alternatives. I've talked about the model. I talked about ZPay. I've talked about all the ways that on a relatively safe basis, and when I mean relatively, I mean with less volatility than doing it a different way that has more volatility, to extract yield so you don't have to worry about your assets going up and down, and that you can clip that coupon and get that yield so you can pay the bills. But in the environment we're going to go into over the next quarters, maybe years, of stagflation, recession, sluggish growth, whatever it is, slowdown or contraction, all asset markets really don't behave well. But bonds at some point start to work again. But that 1.4% you see there is still worse than inflation. And even as bonds start to work again, 4.2%, most of that is coupon, not capital gain. So you don't have the coupon today. You just don't have a lot of options. And it's painful. It's so painful. So people are taking risks that they generally may not be comfortable with. And so that is, so then the next part of it is, well, here's the cycle. And so let's take that Ray Dalio framework of growth and inflation, and let's look at the business cycle that we just looked at the asset returns, and say, well, where are we today? Where are we heading? And how should we tilt our portfolio to what tends to do better, right? So this is kind of where we are today. And if we're indeed close to a peak, bond yields start rising, stock market starts topping out, commodities rising strongly. Sound familiar? Property prices rising strongly. So that's probably where we are today, but let's put the lens forward, because markets are a discounting mechanism. And when you know, property prices weak, commodity prices weak, stock market, you know, weak, falling. So this is, there's not a lot of safe in the future over the next couple of years. And I'm not trying to be a scaremonger or anything like that. I'm just looking at what I see and trying to give you some of my thoughts and how I position things. And, you know, I play defense, and I give you some ideas, but there's not a lot of some of these things that individuals can do in their, you know, RSPs and generically with ETFs or stocks. So let's talk about investment factors. I've done this over the years, and from time to time I bring it back. And so if we're going into a recession, stagflation, slowdown, which factor tends to give you the best? So look at the list here. There are 200 factors. These are some of the more popular ones. Many of them have ETFs linked to them. Which one is it, folks? You don't need to be a genius to look at it quickly and say, profitability is interesting. Hey, Larry, what's profitability? It's exactly what it says. The consistency of profits in a company over different parts of the business cycle. So when we're in a strong growth mode and recovery, investors don't care. They want Tesla. They want the story. They want the growth. They want the vision. They want, and money flows away from stability into speculation. And it could last for years, and nobody can time it and tell you where the top's going to be. And anybody who tries to do that, you should avoid because they're charlatans. These are factual, this is going back, I believe this study went back to 1962. Profitability in and out of economic environments over long decades is the best factor to invest in the phase that we're heading into. Now, if you don't believe that we're heading into that phase, okay, different debate. But if you're following me and you think I have a lens on where we're heading, and you saw that last graphic and you recognize where we might be, you feel that inflation coming, what do? Because if you must be invested to generate yield and potential gains versus going to cash and trying to time the market, many of you who've tried that, some success, some not, some frustration, it's hard. I've spent 35 years trying to perfect it. I'm not there yet, folks. The markets, to try to time the markets perfectly is hard. To try to tame the markets and take the edge off and reduce the volatility when you might go through a difficult period. That's the panacea, right? It really is. Not everybody has that lens, but I'm telling you folks, that's the right lens. All my 35 years of work and research and making mistakes and doing everything, it's about just trying to make a better decision. So I want to focus on the profitability factor. And there's a lot of different charts. So this one is numbers. There's charts like this one that you've seen. BMO runs one like this that looks at color. Some people are more visual and they like this better. So whatever it is, profitability is where you want to be. Momentum, a little bit related to profitability, and that's the trend in kind of profitability and price. But low beta, investment factor. Now, what's the market factor? You see that at the bottom there, the worst. What is the market factor? So kind of let's kind of have a look at that. So what is the market factor? The market factor depends on the macroeconomic cycle. It's the excess returns over the risk-free rate. And so what is the risk-free rate? That's what cash pays today. And what are excess returns? That's the return above the safe money. So in a recession, the parallel return and then the forward, like it's not good. Okay, so the market risk right now is terrible. And you can go to cash and avoid the volatility of the markets, or you can rebalance your portfolio so that if the markets do go down, you don't go down as much and you're still earning your dividends and you still have some good companies. And it's just a different way to think about investing, okay? May not be for everybody, but as an institutional investor, where I've got a mandate to be invested, what we've done with the BMO funds that we run in ZZZD is in the last couple of years, we've completely divorced the idea of, what ETF should we own in those funds from the market risk factor. And as I've tried to educate over the last year or so, using these option strategies to dampen the volatility in the portfolio, as opposed to going to bonds or gold or some of the other things that we've had historically to lower risk that actually have worked really crappy over the last year. And until very recently, gold equities were a big dog. And in the last, say, month and a bit, gold equities have been ripping. But for the last year and a half, since the peak in the middle of 2020, gold equities have been, a trend down. So it's about trying to be in the right place at the right time, in the right investment factors where the underlying securities outperform. So let me take you again into my boring lens. And when I say boring, I'm referring it to boring as in you know, dull. It's not about the exciting story. We're not at a point in the economy where it should be about exciting stories. It should be about capital preservation. And also boring by the way of Elon Musk, boring, you know, drilling down. So I wanted to give you that lens. And last week I showed you some spreadsheets of some of the sectors. So when we do our factoring, profitability and quality and value really are overweighted right now. And when you look at some of the things that pop out, one of the sectors that looks interesting now, rising rates, underperformance for a while, is the housing sector. And so, you know, again, I look at ESG, I look at all these things. I want to buy, as I've mentioned, when the current price is 20% below the profit target. So, and there's a catalyst, and we're oversold, and so the timing works. So looking at the home products, so today we wrote puts on Home Depot. I don't like it at 306. The analysts think a year from now it's 375. I don't like the risk return here, but the PE right now, as long as earnings remain stable, is 19 on a forward basis versus the 5-year average of 23. So now all of a sudden there's some value there, but I still don't like the market risk aspect of Home Depot. It's a high beta name, relatively high. One is market, it does with the market, a little bit less than the market. Correlation, a little bit uncorrelated. So I like it. Dividend 2.23, not really exciting, but there's a nice dividend there. But I don't want to own it at 306. So let's take a little bit of a dive into that. And then the second one we're going to look at, I actually wrote puts on Whirlpool today too, for my option-based strategies. And we own DR Horton in the housing sector. So let's take a bit of a dive here. And we're going to look at Home Depot. And again, when it reached its price target up here, it's just not attractive, right? So we've owned Home Depot. I wrote puts on it here. I wrote puts on it again here. We didn't get put. I'm now looking at it saying, you know, it got oversold here, but really, you know, where would I want to own this thing? And I came up with around $250 that I would be comfortable kind of holding it at. So when we look at Home Depot, you know, what does it do? What's the current PE, trailing PE, forward PE? You know, we kind of look at the fundamentals of it. We drill down, we look at the revenues and earnings, and I'm not going to click through all that now for you here. And then we look at, well, what do the analysts think this is worth? And one of the most recent ratings. So the most recent analyst stuff were a buy. There's more buys than holds and sells here. What does the analyst think it's worth that has the sellout on it? And so it turns out a month ago, Morningstar rates things based on a model without having very much analytical thought to it. So I discount a little bit of what Morningstar said, but their fundamental modeling had this at 250 compared to the pom-pom guys, and the pom-pom guys being the street and you know, the storytellers, if you will. And you know, what do they think it's worth? You know, Goldman Sachs in February had it at 402. The most recent ones were in mid 350s. The neutral guys, the hold guys are, you know, 314. So the guys who are negative on it, I kind of want to know what they think and what it's worth. And you know, that 250 kind of stood out to me. And that's kind of where I came up with that number. So I look at my option structure. I say, well, what could I earn, you know, over the next month, you know, at 250? So I can write a 250 put for June. Okay, so this is actually the June contract series. And the 250 I could probably get well, the last trade was 209. I could probably get, 207, 29, probably get 209, 210 for it if I put an offer in at that price. You know you're going to get 207. And so based off 250, what is that yield? That's how I think about, so over 2 months now, June is 2 months away from today's option expiry. Options normally expire on the third Friday, Good Friday, so they expired today. So I actually chose the 255. It was right at that most bearish target. I sold that option. I got that trade there, 242. I think that was me. So that's where we wrote the option. I got 242 US. Translate that plus 25%. So you add 25% to that, you get about $3.20. $3.20 as a percentage of 255. I'm earning about 1.25%. I'm just rounding, easy math, for the next 2 months while I wait to buy Home Depot at 255. Now, if it gets to 255, I must buy it, and I must be happy buying it there. And I am. And I'll earn that yield while I'm waiting to buy it at that price. And we do that analysis on the 800 stocks in our universe that we screen for. You saw partial on those lists using factors. And so the question then becomes, how do you want to own that? So here's DR Horton, DHI ticker. I own some already because it meets my criteria. So I own some here. But if I was looking to add more or write options to generate yield, what would I do that? But I'm happy owning some here. So DHI, what do they do? So this is one of the reasons I prefer this one over some of the other holdings. So these guys sell single family homes designed primary for the entry level and move up markets. So this is the low end of the home builder where it's still more affordable on price. And the person that was going to buy that higher priced home with interest rates going up, if they want to buy a home, may need to buy a DR Horton home now and get into that more of that entry level market or that move up market, the second home market. So I like them for that. Look at the valuation. Now, if they can't sell any houses, obviously the earnings will be impacted. And that's primarily why these things trade at a very, very low multiple. They tend not to be good dividend payers, but the S&P 500 dividend overall isn't much lower than that. So you're not buying DR Horton because it's a good dividend payer. You're buying it for growth and capital gains at some point down the road. I like it fundamentally. I like the markets they're in, southeast, southwest, migration in the states down to the south. You got a whole lot of metrics here on why this makes sense. And it's getting sold now because interest rates are going up, not because DR Horton's a bad company. So again, what do the analysts think it worth? Well, 3 ratings came out today, BTIG, Morningstar, and Wedbush, and 126, 113, 125. Average price target of everybody who has an opinion on this thing, 112. And as we saw here, it's at 73 bucks. So it meets the nut. There's good value there. But again, how do you want to play this? So again, looking at the June options with the stock trading, in the $73 range, you could write a put for June and buy it at 65 and take, 210. That's 3%. That's almost 3 times the yield of the thing over the whole year. So what I'm trying to do here is show you ways to get yield that you can live off of while you wait to buy stocks you like. Now, I started talking about the factors. Again, I use factoring when I'm drilling down and picking my stocks based on where we are in the economic cycle. And when we go into a different part of the cycle, we will put a different lens on the factors and we will get a different group of companies that have a tendency to outperform better in that kind of a market. So, lo and behold, Dimensional Advisors, who has decades of experience in factor-based fund management, recently converted a bunch of their mutual funds into ETFs, and they actually launched 2 new funds earlier this year, one in March international, one in February US, that uses the profitability factor into selecting the basket of stocks. So I thought it would be interesting to look at what they did, what they came up with based on what I have in my universe. And I looked at this list and I said, ASML, that's in my group. BHP, that's in my group. LVMH, that's in my group. GlaxoSmithKline, Novo Nordisk, Unilever, Rio Tinto, Diageo, Sony, Bayer. These are all names in my universe. Go figure. So it doesn't matter kind of who's doing it. Factor-based investing, generates similar kind of, here's the solution. So the ETFs haven't been out very long. Again, this one barely a month, not even a month. I featured it Monday. I updated the charts here as of today. And you can look at the performance relative to certain benchmarks. So this lens, since it started, it's not a month, it's done exactly what the International Global Index has done. That VT, that Vanguard Total World, down a little bit more than 2% since it launched. And I'm not saying that's good or bad at all. I'm just saying it's a matter of fact. The US ETF on the next page here, DUHP, is the US, and I look at those names: Apple, Microsoft, Amazon. Well, they're in my universe too. I don't want to own any of them right now, but in my option strategy, I've got ratio put spreads on Apple, Microsoft, and Amazon to ultimately buy them lower and make money on the option structure if they sell off. And so, again, having flexibility in the environment we're in today, even though I love factoring and ETFs are there, I think we're entering a period of time when individual securities and strategies around individual securities kind of offer you a better solution. Now, if you don't have the tools to navigate the options market and you're not good with that, you're not familiar with option strategies, then again, feel very, very comfortable in tilting portfolios. They go up and down with markets. So have a look at the US one relative to the VTI, which is the Vanguard Total US Market. And you can see, since this launched in February, again, it's only a couple of months, not even, that you're starting to see a little bit of outperformance. Not a lot, but a little bit. But over 2 months, it's outperformed the broad US market by a couple percent as of right now. Now, at the very peak, it didn't. And at the troughs, it didn't go down as much. But that's what this should do over a longer period of time in a very difficult market, is do a little bit better than your broad market index, your S&P 500, et cetera. So tilting your portfolio away can help reduce volatility and can help increase average return. And that, folks, is the message tonight in terms of factoring, investing, and so forth. So, last week I didn't have a time to get through all the questions. Let me go to some of the online ones tonight and see, answer some of those, and then I'll get into the emailed ones that I've prepared answers for on some of them. So, question from Mark: is it time to get back into gold? So let's bring up a chart here and have a look at our gold chart here. So, to me, it's time to get into gold, down here. There's the crowd that likes to buy breakouts. If you're a pure chartist, you kind of look at this pattern over the last 5 years or so, and you kind of call this a cup and handle, and that's kind of, it's a bullish pattern. We went up to the highs here and failed. Is it going to break out? I don't know. It should be behaving a lot bit better. But I'll tell you what, if inflation cools and bonds start to rally, you know, or sorry, and bond yields go up a little bit more, bonds start getting much more attractive relative to gold, and gold performs poorly. So the correlation between gold and interest rates has broken down recently. There's a lot of chatter on the internet about this being interesting. I sold some of my GDX. I've been long, if you go back on the BNN tapes, when gold was doing this and we had this multi-year base pattern, I started to get really bullish in here because I was kind of anticipating what was coming. And so gold should be higher, it should be 2,500. Doesn't matter what Larry thinks, it's not working. So, from a trading perspective, I don't like it as much here. I liked it down here. I'm a risk reward guy. And so right now I've been trimming a little bit into strength. When we bring up GDX, and we kind of look at the same, couple year picture here, the chart kind of looks the same. So we're probably going to retest this. When gold spiked here, gold equities didn't get anywhere close, even though gold did. And now it's starting to work and break out, and so it's exciting. I trimmed a little bit of the GDX into the strength. I still have decent sized positions, but my inclination is to sell against this high, not to expect a breakout. It might break out, I don't know, but Mark, that's kind of my lens on gold right now. You say, is it time to get back in? You should have never been out. I was adding in here. I'd been selling every rally for the last year and trimming. So, it's both. And so, no, I wouldn't be buying a breakout here. But if that's your mindset and your momentum, I think there's a reasonable chance that we get back to those highs. Maybe it breaks through a little bit. Maybe it doesn't. We'll kind of see. But, my mindset here is to trim into it. Okay, so good question there. Larry, thank you for the I understand crypto miner Hut 8 has a business model. Again, asking about crypto, James. Listen, my views out there are not silent ones. I think it's a tradable asset class that has tremendous volatility, and if you're a trader, have fun with it. I can't tell you what it's fundamentally worth. I think it's worth nothing. I think it's no more than a tulip bulb. I think it ultimately gets regulated away. I think it'll be heavily taxed. It'll be a lot of disincentives to use it by. The whole idea of DeFi and the excitement in the story, listen, I get all that. But I'm the idiot that missed it, I guess. I've got a trading friend. Apparently, he's made $25 million trading crypto, and apparently not paying any tax on it. I won't tell you who it is. Anyways, so who's the fool? Anyways, I don't recommend. I'm never going to recommend being in crypto or anything to do with it. So I appreciate the question, James, but I'm not going to recommend anything crypto or not or anything. It's tradable. For now, it's an asset class. It's somewhat correlated sometimes, somewhat uncorrelated, and that's kind of all I said. Larry, do you think the S&P 500 is higher or lower in 6 months? Fred. Lower. I think we're going into a recession. I think the markets are telling us that. I don't think equities are priced for that right now. So lower is the answer. How much lower? I don't know. Where's fair value? Right now, if earnings hold, 36 to 3,800, given my expectations of the world and what the recession is and how it kind of plays out. If the recession's bad and earnings are sticky and the Fed has to keep raising rates, earnings come down significantly. There's there's no growth in earnings, but earnings come down significantly, then you're talking about a 2,000 something handle on the S&P, 2,800, 3,000, something like that. That scenario for me is not on the table at the moment. 6 months from now, lower. Do you find that 2 months out is the best timing for selling puts? So Lawrence, in my model, I look out 1, 2, and 3 months. The time decay and earning most of the premium comes in the last couple of weeks. So the ideal time frame between your theta and your delta decay, not delta decay, your theta, which is your time decay primarily, is the last couple of weeks, and it's kind of got this parabolic nature to it. That's the structure of it, and so my mandate and why I look 1, 2, and 3 months is yield driven, because in my model I want to generate 6 to 8%, and I'm looking for that, and I want to earn it consistently, and I want that time decay working for me. When I'm buying options to speculate, I don't want the theta working against me. So then you go longer term when you're buying it, unless you're so precise on your timing that you can buy a 1 week or a 1 month and not worry about the theta cost and the time decay. And I don't know anybody who's that good, but a lot of the gamma traders, go very short term, and that's all. That's not investing. That's scalping, pennies. And so it's a game to play, but I don't play that game. So 1, 2 months is the sweet spot. Sometimes 3 months if I can't find a solution in the 1 to 2 months, and I want that name on my book. So good question, Lawrence. Mark is asking about DUHP. How would the minus 7.5% dividend of JEPI affect comparison with DUHP? Okay, I got to refresh my mind on JEPI right now. So let me do that. So many ETFs out there. Income Incorporated, JP Morgan Premium Income ETF that's actively managed. Let's kind of have a look. Mostly US, electric pharmaceuticals, holdings. So it's got some derivatives in there. It's holding, dividend paying stocks. So, it looks like it's got, a high dividend covered call kind of thing to it. If I look at the composition of returns, let me throw that up to a ZPay. Let me look at the US dollar version of that. So I don't have a currency impact. And then let me look at ZWU, which is just the BMO high dividend. ZWH. It's the US dollar version of that. And let's have a look at those. So it looks like it's a high dividend covered call kind of strategy. And so, DUHP, there's not going to be history here, but let me just see if I can see DUHP, and just let me see if I can bring the underlying index in. So there's no underlying index that I have here, so that's unfortunate. I can't do that historical analysis. My sense would be, the profitability has a correlation with the high dividend. High dividend, high profitability companies tend to be good dividend payers on average, not exclusively by any stretch of the imagination, but there's probably a bit of an overlap and a correlation. They are very different things, Mark. So I'd have to do some more work on it to really get back to you on that. But okay. I held on to some real return bonds, hoping they would be a hedge for inflation. They dropped. I mentioned previously that all bonds would go down. So, real return bond ETF, you kind of look at that. And this is what I've said, that a lot of these specialty type bonds, folks, leave them to the experts. They're instruments that for the average investor, you have to understand what you're investing in. And no disrespect to anybody out there in the do-it-yourself world at all, but my experience in the questions we get on Berman's call and here are like this. And what it tells me is that people don't know what they own. And to me, that's upsetting, and why I spend so much time on the educational side. But obviously I can't be there every day for you. I can't answer every question for you, and I can't hold your hand, so to speak. So I want to teach you how to do it. Real return bonds have duration risk. Real return bonds adjust to the expectation of inflation, and the actual coupon adjusts to the realized inflation. And for periods of time, those things diverge, quite a bit. And if this move up here, the stability in bonds where nominal bonds were falling but reals were rallying, that part was pricing in the expectation for inflation rising. And actually, as inflation has come in, what this tells you, and this decline tells you, that the actual inflation realized has been somewhat less than what was anticipated, and therefore price decline. All these very specialty type of bond things, are not for the average investor unless you really understand, how to use them and what you're doing. And so it's a good question, but the answer is, the question really said, do you expect them to recover? And this is a cognitive problem that everybody has. It's like, I'll sell it, but I want to get even first, right? My sense is that you bought it, somewhere with an 18, starting with an 18. And the question is, the answer is probably not. Eventually, a year or 2 years, perhaps, but probably not. Okay, so don't average down, don't keep buying it. Know that you made a bad decision and find another place for that money. And this is why I said bonds are broken, and people only know that they want to use bonds to protect. And it's going to be a broken asset class as inflation rips the heart out of so many asset classes that I've kind of talked about tonight. So that's some of the online ones. I can't get to all of them. I do want to get to some of the ones that people wrote in for. So let me go back to here. So someone invests with Bank of Nova Scotia, I assume at a discount, maybe not. Someone recently recommended Chilean banks. And so there's some American depository receipts for these that trade in New York. And they were asking a question here based on the NYSE ticker of ITCB trading at 3.25 versus the one that actually trades in Chile and has trades at 1.745 as of that question being written. Always thought tickers on different exchanges and different currencies traded about equal value. Is there a reason for this? So I did some analysis. So ITAU Corp, so Chilean bank, right? When you look at, okay, so there's a yield of 5% on it. Market cap, $2 billion company seems a little small for a bank. So I would be concerned about that. But I looked into it and it says underlying IT Corp has one receipt equals 1,500 shares of the underlying security. Okay, so I pulled up ITAU Corp that trades in Chile. I converted it to US dollars and I multiplied it by 1,500. And sure enough, there's your 3.25. So great question. People don't understand what they're owning and they go buy these things and it's so frustrating. The tools for free largely aren't out there to do. I'm able to do this because I have some of the tools that allow me to go do this. Now, having said that, I don't own Chilean banks, but I've been buying Brazilian banks, ITUB, Unibanco. Okay, so, I looked at this pattern, base building here. I like to buy weakness. So I look at a catalyst and we were down here. Risk return to me looks good relative to the lows of the last few years. And I was buying ITUB, in here. This is, this still has it times 1,500. Let me take the multiple out of that chart. Sorry for that. I was thinking, this doesn't trade at that price. So I was buying it under $4. I accumulated a position and I've been trimming it recently. So right now I'm actually trimming my exposure to some of these banks. They've had a good run. You might say, hey, Larry, it could get back up to here. I agree completely. When you trade one of these banks, you're owning the Brazilian currency or the Chilean currency in the exposure. And you got to be mindful of that. I've trimmed it here. I think we're going to get a pullback to the low fives, and I'm going to add it again. And again, I'm very, very active with our investing in these kind of things. So thanks for that question. Hopefully that helped. I'm nervous about the rising interest rates and the Bank of Canada announcement. What does it mean for ETFs broadly? Do you look at certain ETFs in a rising rate environment for return potential? So I talked about that tonight, that the profitability factor in the period we're going into of rising rates and slowing economy and higher inflation, the profitability factor is likely to outperform. It doesn't mean it's not going to go down and it's going to go up. Generally speaking, most assets are going to go down. If you're the kind of person that can't handle the volatility and wants to try to time the market of being all out or all in, good luck to you. It's very hard to do coming from someone who specializes in doing that stuff. Try to think of my lens on factors. Try to incorporate some of those ideas into building a portfolio that will withstand the next few years and it's comfortable to the volatility level that you're comfortable taking so you can sleep at night. And that's really what I would want to tell you there. I have about 700K you want to invest over the next 2 years. I understand Canada is only 3% of the world, 50 to 70% international, perhaps 30% in Canada. So here's my thoughts on this. If you're the taxable part of your portfolio, where the dividend tax credit is a benefit, and you like dividends from Canadian companies, put all of that in Canadian companies in your taxable account so that you get that higher yield and the benefit of the dividend tax credit. And everything else, I don't know if that's 30% for you, and everything else that's registered. The taxability of that is on the deregistration of that money when you take it out, not when you buy and sell. Foreign dividends treated as income in taxable accounts for tax. Capital gains are capital gains. If that capital gain is a foreign investment or a Canadian or an option strategy, capital gains. It's capital gains treatment. In the registered account, doesn't matter. It's all income when it comes out. So how you're positioned, you're 72 years old, you're probably not making any more contributions. I don't know what your mix of taxable versus non-taxable is, but those are some of the things to think about. I hope you have a lot more than 10 years of investment time left. I hope I have a lot more than 30 years of investment time left, being in, going to be 57 soon. So it's a long time horizon, relatively long. All the bonds that you would want to have, listen, bonds are terrible. They're safe, but they're terrible. Look at some of those volatility protected equity-based ETFs. Learn how to use the innovator ETFs. Call one of the companies that supports us, ETF Capital, or someone in the Q Wealth universe. Get interested in the portfolios that I manage. If you want to do it yourself, great, do it yourself. But that's how I would think of that. 50 to 70 international, put it in the registered, and don't worry about the taxability of it until it comes out. Twitter, Elon Musk. I'm bidding 54.20. What a character that guy is. And then he makes a Vancouver today and says, I don't know if I'm like, I think this guy is trying to manipulate markets. I think he's a brilliant man. He may be a high functioning sociopath. I think he gets off on Twitter and tweeting stupid things, and it gets off on the publicity, but he's one of the richest men in the world, and kind of does what he does. But the question here is, how does a public company traded go private? So ultimately, if it's successful, you have to tender your shares, and they get taken over at that price. That's kind of how it works. Doesn't matter how small of an investor you are, you will have the ability to sell it at the price that it's taken over private. If they're seeking 100% of the company, and there's shareholders that don't tender, that's more complicated. But at the end of the day, those shares will get done at that tender price, and it'll be recommended, and there'll be a shareholder vote, and you won't have a choice, and you'll have to tender your shares. Why have technology stocks been struggling over the last several months? So on average, technology stocks don't pay a big dividend. You can look at the NASDAQ, the Qs, and look at the dividend under 1%. You can look at a broad swath of technology-only companies, and you can look at how much dividends get paid out of Cathie Wood's ARK ETF, and the answer is almost none of those companies pay a dividend. So growth companies reinvest their earnings, if they have any, in growth, or they're borrowing money to reinvest to grow. And so there's no distribution, there's no dividend. And so they're thought of as long duration assets. So a duration is how long does it take to get your money back, right? And so when we're in an environment of rising rates and you don't have that income, those companies are less favorable because we're going into an environment where things are slowing. And a growth company in a slowing economy is not a good investment. A growth company in a rapidly growing economy that has, stimulus and budgets being passed and money being spent, that's not the next 2 years. And that's why technologies have been struggling, because we're going into an environment where profitability matters. And if you're not profitable, don't care how good your product is, the market's not going to reward you for that. So that's yeah. Terrible stagflation in the 70s crippled global economies. Is there a chance we're heading there in the next 5 years? We're not. It's unlikely that we go into an environment of the 1970s. I've said for a long time that inequality is a major social issue. I believe it's in part why Donald Trump was elected. I believe it's why we see the polarization in politics. I believe it's why Max Bernier started his own party. I believe it's why Bernie Sanders, and AOC actually exist. And so everybody, the extremism, and it's because of issues relate. So now we're in an environment where all the tailwinds of the growth of the demographics of the last 50, the baby boom, all that best news is behind us. And we're going into a period here, but the 1970s, think about the 1970s. You were born in 46 and 50 and 55. And so the 1970s was that cohort now starting to enter the workforce and earn money and spend money and demand and labor and industrial was still a big part of it before Reaganomics and globalization and Thatcher and everything else and that was the 80s and 90s, and to the extent there'll be a little bit into the 2000s. So we're in a different environment today. Unions are getting stronger. You're hearing about these votes at Amazon and the Starbucks places. And I don't think we're going back to the strong unionization and the industrialization of the 70s. But the onshoring theme and Buy America, I talked a little bit about this last week, is going to keep inflation at a higher rate. And again, bad for all assets. So stagflation is a very real outcome. I'm happy to have the debate. There is a debate to be had. There's a lot of disinflationary forces, including all the debt in the world, that says inflation can't stick and deflation is a bigger risk. And I can advocate for that, not for the next couple of years, but as the global economy rebalances and that shock, one-time, two-time shock of repricing things filters in, then I think inflationary pressures come down. We're not going to need to break the inflation like Volcker had to, I don't believe. But we'll see, right? So again, we're kind of out of time tonight, folks. It's a long weekend. Thank you for everything you do. Thanks so much for your support. I'm going to leave us on this kind of last slide here, an appeal. Again, thrilled to match your donations, folks. Great causes here. Visit one of our websites, our partner companies here. See what they have to offer. Maybe there's a solution for you. Have a great Easter. Have a great Passover. I'm a bit of a mutt. I've got Jewish DNA, I've got British DNA, I've got Irish DNA, I've got Ukrainian DNA. That's the Jewish piece for me. And I'm celebrating both this weekend. So have a great long weekend, folks. See you next week. Be safe out there.